Hello, everybody. Thanks a lot for joining us on this live. We'll just get started in a few minutes. So that should we wait for a couple of minutes for more people to join in?
Yes, we'll just wait for a couple of more minutes and then we can start.
Perfect. So what we'll be talking about today is the broader market, right? What's
Yes,
happening, I think the title of the live stream is consumption back. So I have a lot of data
right,
that I want to present on why we think that good time
right.
to
I think
invest in consumption.
we all are very excited about this, and given the recent GST impact, also, I think consumption is going to be driven. Also, to all the investors who have joined in, if you have any questions, feel free to drop it in the chat window. We'll try to take it up after the presentation during the Q&A session.
Perfect. All right, so maybe we'll get started, right? More people can join in as it goes.
Sure.
So I have a quick presentation for everybody, and uh, then we will go to the Q&A, right? All right. So here the main topic that you want to cover is that we're seeing a lot of signs that hint at resumption of the consumption cycle, right? Consumption, we see that it's going to pick up, and we'll cover a lot of things that hint at that. But before we do that, we'll be talking about the broader economy as a whole, right? So we'll start by talking about the broader market trends. What we're seeing right now is you saw the market sentiment actually pick up some time back, and we actually did end up sending out a message to our clients, if you remember, Siddharth, early in August, that it's a right time to top up somewhere around this time,
Yep.
and it ended up proving quite well. And then the tariffs, once the 50% tariffs, once they have been in place, we're seeing some correction from those levels, but we think it's a short term phenomena, and we're quite positive about the outlook from the market. uh, and we actually are suggesting people that might be a good time to allocate to the market, and we'll talk about where do we see opportunities in this market. If you look at the market right now from 2025 to now, you would see that large caps have been stable, but your small and mid caps have been a little bit volatile in the beginning of the year. If you look from, let's say, April to now, obviously small and mid caps have recovered faster, right? There's been a sharper recovery, but still on the overall level, you can see that small and mid caps are slightly lagging behind the market for the whole year. If you look at the factors, right, we're talking about value, momentum, quality. What you would see is that for 2025, your value factor seems to be doing at par with the market, and your quality is still stable, but momentum is still lagging behind, right? So that's the trend that you're seeing, that over the past 5 6 years, we've all been big fans of small caps, and we've been huge fans of momentum, but these two indices are lagging behind the broader market for 2025. Obviously, since April, like we said, there's been a very strong recovery, especially in these two things, momentum as well as small and mid cap, and we expect that to continue. But that's what the current scenario looks like. If you're looking at sectors for this year YTD plus, since the drawdown recovery in April, you would see that obviously autos as a sector have done pretty strong this year. Defense did really well for a short span of time, but it was very sharp up move. Autos have done really well. Along with that, you're seeing financial services do really well. You're seeing rural consumption is picking up. You're seeing consumption as a whole, banking, infrastructure. These are the sectors that seem to be leading the market. And on the other hand, you're seeing IT is really lagging behind. You're seeing some drawdown in the consumer durables also, probably because the discretionary spending hasn't picked up, and secondly, due to the monsoons, you're seeing AC sales and stuff like that not pick up really well. And due to the monsoons, you can see again the rural segment has done pretty well, right? So that's what the sectoral view right now looks like. And the big thing that is impacting the market right now is the tariffs announced by Donald Trump. Right, Donald Trump has come and announced a 50% tariff. He started at 25, and then he's saying that due to India's import of oils from Russia, he's going to impose 50% tariffs on India, and he might increase, or the negotiations might happen and they might settle to a lower number. So it's still very speculative right now. But as such, due to the Trump tariffs, the sectors that we see impacted the most would be agriculture, right? Agriculture is where they want to negotiate quite a bit. India is not budging there, but there could be indirect impacts of the US China trade shift there. Manufacturing, obviously, steel, auto components, machinery. So that is manufacturing is where they really want to target, and they want to shift that manufacturing to the US. So you'll see impact. Pharmaceuticals. Right now, you're not seeing that much pressure, but there's some rules that are going to come up in pharmaceuticals for tariffs. In terms of textiles and apparels, I think that is one big sector that will be impacted because other emerging markets like Bangladesh, Vietnam uh, will become much more competitive, right, in terms of their pricing because the tariffs there are low. IT is not impacted, but might see some impact due to indirect effects. Gems and jewelry is hugely impacted. So even where we work, right, in Bombay, we're seeing uh, there's a lot of jewelry companies, diamond companies around that area, and you're seeing actual impact happen to them. Electronics, global supply chain will be disrupted, and renewable energy because there are restrictions coming up out there, and maybe on some other chemicals. So these are the sectors that you might see some impact. And what you would note here is that your consumption sectors, your a lot of your industrials are sort of out of this picture, and that is where we are seeing um, our focus go to. Even a lot of banking and financial stocks are out of this scope, so that's where our focus goes to. And we'll now look at the macros that hint at a strong consumption pickup. So what are the policies that are driving consumption pickup? I have this time I've used a little bit of AI to create these mind maps, right? Which will give you a good picture on what we are thinking, right? So there are a lot of policy things going on. The government of India, RBI are doing a lot of moves to boost consumption in India, right? One thing you would note is the big thing, which is the GST reform that were announced during the 15th of August announcements, where the GST slabs will be reworked with a 12% and 5% and 28% will go away, and only 18% and 5% would stay. There would be, so which would lead to more money for disposable income, discretionary spending, right? And festive season would get a boost where people will spend more on consumption, right? So that is one big thing that could boost consumption, and you're already seeing people sort of work on that. Second is inflation is at a low in India. Interest rates have been front loaded. Interest rates cuts happened early in India, much before the US. Secondly, the government has been spending a little bit. You can see capex has picked up in India. And finally, this surplus liquidity, because the RBI has been managing liquidity, and there's a lot of bank credit and surplus liquidity in the market. So all of these signals sort of will help boost consumption. Also, the tax rate cuts that happened, which are already in effect, those will also bring in some disposable income for uh, the working class to sort of spend on consumption. Along with that, I think there is a couple of more things, right? For example, the ban on online gaming, the restrictions on FNO, right? When those things get stopped, you would see money now being channeled into the cash market. so which will increase the depth of the cash market in India. And secondly, you could see some of that money actually go into consumption. So those are indirect reforms that will probably help consumption. So this is a very encouraging number that we saw day before yesterday, right? So this is India's GDP growth rate, right? So India's GDP growth rate came at 7.8%, which was very encouraging. You can see it's a pickup from last quarter. But then again, if you have to look deeply into it, you will see that this is a statistical uptake because the GDP deflator has actually been worked on, and it's the lowest for the past few years. And the real GDP, you can see it's 7.8%, but nominal GDP is actually decreased. So it doesn't mean that the growth has really picked up, but this is statistical working that has happened in this number. But 7.8 definitely looks attractive. um, Inflation has cooled off. You can see that inflation is at a multi-year low, right? So inflation does not seem to be a worry for the Indian economy right now. You can see the rural growth has been picking up, right? So if you look at from Q4 FY24, you can see that the rural growth has actually been higher than the urban growth, and it has been slowly picking up. I think the monsoons, a number of policies that are favoring rural consumption are sort of boosting these growth numbers. So that has been a positive. Urban growth is right now lagging behind, but all these moves that are there, like the GST reforms, etc., could help boost the urban volume growth as well, right? But rural definitely is seeing a strong pickup. Like we said, the rate cuts have been front loaded. So the rate cuts have been, they happened in May, and the early rate cut would pass through the economy faster, right? And if the rate cut passes through the economy faster, that would lead to growth coming in sooner rather than later, right? Monetary policy also, we talked about that the money supply is rising in the economy, which means that there is more currency in circulation, more liquidity, right, which would help consumption. Another encouraging number here is that we saw government revenue expenditure as well as capital expenditure increase over the past few months. So one was the defense spending, right? So around after the altercation with Pakistan, we saw that a lot of defense contracts were allotted, and that led to a growth in defense spending. And secondly, the government is spending on consumption and public revenue expenditure. So I think that number also, the capex has also been front loaded. The government has spent that money early to sort of boost growth, and that's why we are seeing that India's GDP growth number looks attractive, right? Because a lot of things have been front loaded by the government, and obviously the monsoon also came early, right? So that's also been an impact. But the impact of tariffs can be seen here. If you look at industry growth versus services growth, what you would see is that industry is growing slower and services are actually pretty robust, right? Because the tariffs have not been there on the services, but the tariffs are there on the industry, right? Uh, if you look at private consumption, that has not seen a significant pickup, but the government consumption, government capex has actually sort of picked up, right? So that's what has impacted the GDP growth rate. And I think the big thing here when we talk about consumption is the GST 2.0. So we'll try to dig a little bit deeper into the GST 2.0 and see where we could see those impact, right? Talking about the GST 2.0, you would see that the the idea is that they want to put all the essentials in a 5% GST regime, all the goods and services at an 18% regime, and all the luxury items as well as the sin goods, right? For example, luxury watches and luxury items plus cigarettes, alcohol, etc. The luxury items will be at 40%. So that is what the regime sort of wants to do. If you look at the current slabs, you'll see 65% of the goods are already at 18%, but there are various goods in 28% and 12%, etc. slabs also. So what would happen is many of these goods will be recategorized either into 5% or 18%, or the sin goods into 40%, which is expected to ease the GST burden for the consumers, right? So what would get cheaper and what would get expensive? So in terms of things that could get cheaper, you would see automobiles, right? Especially private vehicles. So if you look at the recent times after the announcement, there's been a big upswing on the auto index, right? You're seeing a lot of private vehicles. You're seeing, we saw Maruti do really well. We saw Bajaj Auto, TVS Motors, companies like that have done really well. Obviously, if you look at high frequency numbers, I think many of the autos, we're seeing some uptick in the tractors and consumer vehicles. PV has been a little bit stagnant, but the festive season could actually boost this, and GST impact would actually come in there. Secondly, there will be a big positive for the retail sector products. So you would have seen the FMCG companies, HUL, Marico, Imami, Bikaji, right? Companies which have a lot of goods in 18% category that could be recategorized into 5%. You've seen a big movement in those stocks, right? Consumer goods, so your AC stocks, your different white goods, you've seen strong up moves there. Even you saw up moves in PG and Amber and various stocks, the AC category, right? And like I said, Bikaji, Imami, Dabur, many of these companies, for example, Bikaji has a huge chunk of snacks which are in 12%, which will go to 5%. Similarly, Imami. So these companies will be likely beneficiaries. If you're looking at things that will get more expensive, you know, the 40% slab for sin goods, right? So mostly your cigarettes, right? And possibly alcohol could be some things where you could see slightly higher tax slabs for GST. And there will be no major changes where on other FMCG, paint, ice cream, milkshakes, and other such products. But there could be volume growth as consumer have more money to spend on consumption, right? Another thing that people think about when they think about GST rate cut is, states, right? So a lot of state governments make money through GST, right? So if you look at this chart, you'll see the highest GST is the highest percent of tax revenue for Karnataka, Haryana, Kerala, Maharashtra, and only a few states account for most of the cement as well as motor as well as two-wheeler sales. So all of these states could see negative impact on their tax revenues as the GST rates are cut. But what analysts are speculating is that, okay, the rate cut will impact um, you know the tax that they collect, but the volumes will grow. So because the volumes will grow, the overall tax numbers will not be impacted that much. um, and along with that, talking about consumption, so GST is a big positive that has seen actual impact on the autos, FMCG, and consumer indices. But what we're seeing is the consumer behavior sentiment is also picking up. You're seeing positive sentiment in the rural economy for sure. If you listen to a few earning calls this time, you would have seen a lot of positive commentary on the rural side. um, Similarly, the postponement of purchases is fading. There's a demand uptick happening, and I think the festive season, Ganesh Chaturthi, Diwali, Onam, all of these occasions will bring in more spending, and there is a rising penetration of branded goods in rural India. Plus, demand is normalizing in industries like paint. Right? There are certain industry specific drivers also. For example, in autos, you're seeing a growth in two wheelers, and seeing a growth in tractors, right? And rural sentiment is driving that. Paint and adhesives, you're seeing recovery happen. In home improvement, you're seeing real estate sales have picked up, which will lead to demand for pipes, wood panels, etc. FMCG, I think if you watch the earnings, the volume growth and growth have been pretty stable, right? And even in durables, I think it hasn't been that good for AC, obviously, because of the early monsoon. but the GST is going to boost demand over there in alcobev and hotels also. I think discretionary spending is going to boost those industries, right? So there are industry specific triggers also that hint at a pickup in consumption. So that was why we sort of think that the consumption could be a strong theme to bet on. Obviously, you know, we're not seeing. I mean, we're seeing upticks definitely in the rural side. On the urban side, I think things are getting positive. There's lot of delay in buying because the GST reforms will come after a lag, right? So people might not buy it today, but they might wait for, I think, near about Diwali when the GST rates will come into place, and that would show that boost in growth. But experts across the industry do expect that growth in consumption. That's why this sector is quite attractive right now. But there are a lot more things to look at in the economy when we think about if it is the good time to invest or good time to allocate, right? So one thing here is the earnings, right? So earnings, obviously, if you looked at this time, were uh, similar to last quarter, right? There was not a major upgrade that happened in that sense, right? We were expecting it to be slightly better, but they were not very, very, different from last quarter. Obviously, better than the previous few quarters, but still pretty much at par with the last quarter. If you look at your top line growth and your PAT growth, they have normalized, right? And if you look at sectors also, we saw something very attractive happen in the cement segment, in the chemical segment. So those sectors have done really well. Even energy has done decently well. But if you look at others, consumer staples, discretionary, industrials, IT, real estate, right? These are the only sectors where you only the consumer, only the energy as well as materials, right? So cement, I think, has been the most attractive sector in terms of earnings, and has done quite well. If you look at surprises also, you'll see there were slightly more positive surprises and slightly higher negative surprises, right? So it was pretty at par with the last quarter, nothing very attractive. But if you look at the projections, right? So these are the growth projections by number of analysts across different financial years. To FY26, the growth rate is still pretty decent. People expect FY25 to be the bottom of the low growth. You see in the first quarter actually be attract better than FY25, but people expect the second half of the year and early 2026 to actually be much better, right? So we do expect uh, the next quarter and the second half of the year to actually be much more attractive, and the consumer spending and things like that will be some of the drivers of that growth. Uh, Early capex, government spending, high GDP growth, these things hint at a recovery happening in these numbers, right? But on the overall, you'll see that the EPS revisions have been on a negative side. So people were expecting EPS growth to be 11% for FY26, but after this quarter, they have actually reduced it by 2.5%. That has been some of the drivers for this, right? But still, I think the expectation is that the second half of the year would be attractive. And I've been talking to analysts throughout the whole year, and I think since the beginning of the year, people have been expecting the second half to be much more attractive. I think the rate cuts in the US are going to come. We'll talk about that, and these things will be some of the triggers that will lead to growth picking up. If you look at sectors, you'll see most of the upgrades have happened in NBFC, cements, EMS, internet, consumer, right? And downgrades, some of them have been in the retail, durables, private banks, pharmaceuticals, etc. Right? Now let's talk about valuations also. I think that is one concern that people have, that okay, Indian market is slightly overvalued compared to the peers. So if you look at the valuations, the P ratios for have obviously corrected from the top, but they're still slightly elevated. But then, if you go and think about it, Indian market commands a premium in the current current economy, because you can see that the GDP growth rate is fast, our consumption economy is huge, and that sort of demands a premium. Now, the big event that is coming along with the consumption theme that we're talking about is the US rate cut. That's a big thing that will impact the global economy. And if you look at after Jerome Powell's recent talk, we saw that people are expecting on 17th of September, which is the next Fed announcement date, next FOMC meeting. 86% of the people expect that rates will be reduced by 25 basis point, and people actually expect that there will be other rate cut possibly in this year, right? So, and if the rate cut happens in the US, that would definitely bring back growth in the global economy, right? That would have a lot of impact on our economy. Also, will go through that. And if you look at even the prediction market, so you have the data from Kalshi, where people bet on events, and we'll see that most of the public is also betting on a high probability of rate cut in September. If the rate cut happens, what would happen is, you know, our INR would appreciate, imports will become cheaper. RBI will also have room to cut rates. You'll see bond markets will see lower global yields. The demand for Indian bonds would increase. FII sentiment would increase. That would boost our equity markets. Sectors like banks and real estate would benefit. Similarly, you could see some volatility in the crude prices and commodities possibly, but the borrowing cost would reduce, consumption would pick up, and capex could also pick up, right? So there would be a lot of impact if the Fed rate cut happen in September. So which will be a big positive, right? I think that's something that everybody has been waiting for a while, and if that happens, I think that could really boost sentiment for the Indian market as well. So that is what we had to cover. I'll quickly go over the performance of our PMS strategies also over the last month, because August is over. So if you look at our PMS strategies, you would see we are at par. Factor strategy was at par with the market around. The market corrected around 2%, and we also were in around 2.8, 2.9% in terms of correction. We did see some impact initially, during the tariff tantrum, because of some of the smaller stocks that we were holding, but we saw a good recovery from those levels. Alpha also had pretty much at par with the market, around 2.5% negative. But I think we remain highly confident across both the strategies. You've seen some lag happen, right, which is only in 2025, right? Our factor strategy is doing better than the market on the, I think, 3 month, 6 month level. But yeah, I think 2025 we're seeing a slight lag. Even Alpha is seeing slightly more significant lag. But we're going to see, I think, a strong market, but a narrow market where selective stocks are going to be doing well. And I think our strategies are well equipped to pick good stocks. We've done our back test. On our back tests, we see our strategies outperform 70% of the times, close to 70% of the times, on the momentum index, on the BSE 500, on the small and mid cap index. And because we built a few months of underperformance, I think the outperformance is bound to come. We are very confident on the type of stocks that we are holding, the type of sectors we are holding, and we've done our own multiple layers of research on top of that. And we're very confident of the strategies actually seeing a better time going ahead in the second half of 2025. So that is all that I had to cover, Siddharth. Let's go to the Q&A now.
Yes, thank you for the presentation, Sonam. I think that really helps a lot of investors understand what's happening around the world, how is it impacting India, and what to expect from the portfolio as well, right? If you could talk a little bit about the current allocation mix in the portfolios in terms of how are we allocated to mid, small, large, and where are we planning to allocate it in the next few quarters as well?
Definitely. So, see, again, talking about our strategies, right? See, these are quantitative strategies. They can take any shape and form. We look at multiple factors, right? But essentially, our strategies are designed in a way that we want to outperform the market, right? We think that we have that by allocating to the right factors at the right time, we can bring in uh, solid outperformance over the market. And the outperformance of the market, Siddharth, if you think about it, how would that come, right? It would come only when you go to high growth stocks, right? And high momentum stocks. And when you do that, typically uh, many of those stocks are in the small and mid cap segment, right? So basis of our research, what we think is that around a large cap will possibly only be 30% of our allocation at any given point in time. Right now, if we look at it, across our strategies, uh, you know, mm, like the factor strategy has around 40% odd allocation to large caps at the current moment. Alpha strategy also has a pretty decent, I think, 40% allocation to larger stocks. How will that shape up? I think, as the momentum picks up, as the trends get stronger, we would see, I think, more allocation possibly go to these possibly small and mid caps, right, as the market becomes stronger.
Right. Few investors have a question on the view about the US market. The market over there has been extremely volatile and the debt is at an all time high. So, do we expect any corrections in the US indices and does it affect the Indian markets as well?
See, I think the US markets, again, extremely narrow. What you're seeing right now is six, seven companies actually moving the whole market, right? So from Nvidia to Facebook, Microsoft, most of the AI sort of stocks are just pumping up the market. And I'm a little bit worried about the valuation right now. I think a lot of the charm or the overvaluation of AI is slowly coming down. I think after the GPT-5 announcement, people are getting a little bit disillusioned. So I'm a little bit worried about the valuation over there. But I think the US market would be robust. I think when the rate cuts happen, that would, I think what would be good for the US market is, apart from the AI companies, if the broader market sees a boost, and I think the rate cuts would bring that. And I think what the tariffs are doing for them is maybe bringing some money to their manufacturing segment. So I think, see, there would be volatility because the valuations are at a very, very high levels. But I think the rate cut definitely would be positive.
Right. A lot of investors have the question on the portfolio performance part when they compare it, say, alpha and factor together, right? So, according to your view and basis the strategy that we have for alpha right now, when do we see a recovery happening in it? And what are the measures that are being taken for better risk management?
Right. So see, I'll give you a very clear understanding of the underperformance that happened, right? So see, uh, the most of the underperformance or the negative returns actually came in January and February, right? Which is
Right.
when you saw a meltdown in small and mid caps, panic selling, and in anticipation of what Donald Trump was going to do. I think that is what has bring in the negative performance for and alpha being more concentrated. So imagine you have 10 stocks, and I remember we had high momentum stocks in the capital market segment. So we had CDSL, we had BSC, we had KFIN, etc. Right, and those stocks, you can remember, they saw a very sharp decline when those during January, February, right? So stocks like those saw a bigger impact when this happened, which is fair, which is something that can happen. But things were very uncertain in March, and we, over and above our strategy, we do risk management where we cut our positions and we hedged because we did not want any further loss, and things were very uncertain at that point in time. So we ended up hedging our strategy, and we missed the initial pickup of the market for a couple of for a month or so. Right, March and April is when we missed out on some pickup from our strategies. But things like that happen. I think risk management is a very tricky thing. And But yes, the strategies have been pretty strong. I think on alpha, again, momentum right now is a little bit volatile, right? Because see, themes are being impacted very rapidly. I think the market looks very strong, but there is a very strange phenomena happening right now in the market. One thing that I was looking at, I think I saw it on a news channel also. There are a lot of stocks where you're seeing accidents that have happened, right? So even we have seen a couple of stocks, for example, in a factor strategy, which has not done that bad, but it had PNB housing, right? So even in the last month itself, when the strategy has been pretty much at par with the market, we had PNB housing that saw 20% decline because the CEO resigned. So that was an accident that happened in that stock. Again, we had Nazara in that strategy, right? And the online gaming ban impacted Nazara at a very big level. So see these things, and even if you look at the last earnings, that what you would see is many companies are coming with exceptional earnings, right? So I remember V2 Retail, right, in our portfolio
Hmm.
came with best earnings for the retail side, and the stock hit a lower circuit for 3-4 days after those announcements, right? Because I think people are sort of dumping the stocks at the top, and so a lot of things like that are happening, which can sort of throw off the momentum strategies a little bit. But I think we expect improvement in the sentiment going forward. And again, we look at the stocks from multiple lenses, not just from price trend, but also what are the future growth projections, what is the earning stability, etc. And the stocks that we're holding and sectors we are holding are pretty strong, and we expect the recovery to happen pretty soon. Like I said, statistically our strategies historically outperform the market 70% of the times, right? And that number is going to build up soon.
Right. So a bunch of investors have a question on the factor approach that we have, right? We
Hmm.
talk about factors that we are choosing in the strategy right now, but can you also talk a little bit about the factors that we are not considering at this moment, or which have the lowest weightage to our strategies?
See, we try to look at any stock from the lens of multiple factors, right? And see, I think at any given point in time, some or the other factors will be our focus area, right? That's
Right.
how this works. But what we have done as an improvement on our strategy that recently is that we have put filters across multiple factors, right? So for one is liquidity, right? Which you don't want to lose the grasp of. So we don't want to invest into the stocks that are very, very highly liquid. Similarly, valuations, right? So obviously, we don't put a limit on valuations when we do momentum, right? Momentum, when it says that, for example, look at a couple of stocks like Paradeep Industry that we are holding, is grown quite a bit. Valuations are high, but we're still holding it because the growth prospects are quite high, right? But we will not hold any stocks that is very highly valued in a particular industry. So industry related valuations are very high and their growth rate is not that high. So we
Got it.
do those type of filters to filter out very risky stocks. Similarly, on margins, on ROE, which is quality metrics, we don't say we'll not invest in any stock with less than 20% ROE, because there can be growth stocks that are recovering from a bottom, which might start with lower margins and lower ROE. But we have filters that we will not put money in any stock that is very, very low quality compared to the industry, and a number of other momentum, size, quality. So we do have filters on the worst case scenario for a lot of factors, but at any given point in time, we are allocating to one factor or the other. And we think that our strategies are putting checks and balances on the worst case of the majority of factors, from risk, from US exposure to inflation exposure to number of things.
Right. Um, Few investors have a question regarding a particular sector industry, the IT industry, which has seen a beating in the past, right? But now, what is your overview about the industry as a whole? Do we hold or have any exposure towards this, or do we plan to increase or decrease the exposure in the future?
So we have a couple of stocks in the IT industry. Like we have one allocation which is domestic IT, not internet, not like a large IT exporter, but a mid cap stock uh, in the IT segment, which gains from banking sector in India. Right, so we have that allocation. The numbers have been pretty strong, and the stock is doing really well. So we have one allocation, and again, I talked about Nazara Tech, which is something that we had allocated, saw some correction, but we are holding that stock. Uh, and we do have e-commerce and stuff like that. See, and the IT industry, I've been talking to analysts again, right? I think if you look at the numbers, hard numbers, from momentum to expectations to a number of metrics, the IT stocks are not looking attractive, right? So we don't have a lot of allocation to them. I've talked to analysts also. Analysts come and they talk to us about the opportunities in the sector. What people are saying is that due to the low growth rates in the US, and I think possibly due to AI coming up, there's a lot of negative projections built into the IT earnings, right? So I think right now, if you look at it, everybody is expecting IT to actually reduce their revenues in the coming few quarters, right? They're saying there will be negative growth in IT stocks, larger cap IT stocks in the coming few quarters, right? That's what the expectation is built in. But what they believe is that, let's say, the US rate cuts happen and the impact of AI, which is being built up as a huge thing right now, does not happen as much as it is anticipated, right? There are a lot of reports, if you look at it, a lot of Gen AI, which is being used by enterprises, not seeing a big impact, right? So there could be surprises on the positive side for a lot of Indian tech companies, right? Right now nobody knows how that's going to shape up, but the surprises that they actually expect from this sector could be on the positive side. So you have to watch out for a lot of data. I think earnings, watching out for earnings for these IT companies, the contracts that they are winning would be very important. I think rate cuts in the US could be a big thing. So
Sure.
yeah.
Right. Given the current context, a lot of investors are confused about topping up their existing investments, right? So when it comes to the top up phase, as a fund manager, would you advise investors to do more SIPs or do more lump sum investments so that they could make the most out of the return season that might just kick in post the festival demand and all of that?
See, I think that's a tricky thing, right? I think SIPs should continue as it goes, right? I think in a volatile market, if you're doing SIP, that's the best case, right? You get a very good average price. So that's a good strategy. We, as a fund management company, we do send out our notes when we think it's the best time to top up, right? For example, we sent our note around I remember around 7th or 11th of August, right, when the market was at 24,400. So we sent out a note that FIIs are at the most negative, the most short right now, and that typically leads to a pickup.
Right.
And that ended up being good for a couple of weeks because the market did pick up strongly, but then the tariff impact have dampened the sentiment. But I think yesterday we saw, I mean, on Friday we saw a good move, and we think that's going to normalize.
Mhm.
So we would occasionally say, when we send out a note to add, I think we have a conviction that you could put in lump sum, but that's a very tricky thing, right? Doing a lump sum investment in anticipation of growth, that can, if things work out as we anticipate, that would be great. But there could be risks to it, to anything, to an equity investing, right? Like we also think about our strategies in terms of probabilities only, right? Even though we are seeing some correction in our strategy, you know, uh, we cannot we cannot tell you with the 100% accuracy ki this is what is going to happen, right? But we can tell you in terms of probability that okay, there is a big probability of some recovery happening. But uh, but again, so when you do lump sum, you have to be aware of the risk, right? SIP, you can be much more comfortable in this. Yeah.
Right. No, I think that is fair. The idea here is to stay invested in the equity market and keep increasing your exposure in an incremental level, right? And if you would see better opportunities to double down through
Mm.
larger allocation, which is lump sum. Um, So we've tried to answer most of the questions, Sonam, but a few investors are also asking, do we have any new products in the pipeline? Are we working on any new strategies? So if you would like to touch upon that a bit, that'll be great.
Yeah, so I am actually right now on our small case side, right? So that we are working on a new basket, right?
Yes.
Which will be on the. Do we disclose it right now?
Okay.
I
Rough. I
mean,
think
see,
we'll need to check the small case team as well, but yeah.
yeah. So we'll come back to you. We have a new basket in place. I think it was there on the microsite for a couple of days. Some people might have seen it, but you can understand the theme that we might be working on based on this webinar. But we are thinking of a new basket for a theme that we are bullish on, a thematic basket, and that will also help us understand that segment better. In terms of our strategies on the PMS side, see what we are doing is we're sort of consolidating right now. So right factor fund and right factor fund hedged, we're trying to bring them together to have similar sort of allocation, so that we don't have two variations of that strategy, and then alpha
Right.
would be the high risk version, so that you would have much more consolidation. I think that is the better strategy, right?
Right.
To have more consolidation.
Absolutely.
Hmm.
Right. So for any investors, if you've missed out your questions, I would request you to write us an email. Our team will be happy to help you with that. Some closing notes from your side, Sonam, and then we could wrap this up.
Definitely, I think I would first of all thank everybody for joining us on this session. We, like I said, are quite positive about the prospects of investing in the next few quarters. The themes that we are really interested in are, like we discussed, a lot on the consumption side, on the financial side, materials, cement, chemicals, even on the industrial basket. So there's a lot that's happening, but you have to be very selective, which we think our strategies are really equipped for. We are quite positive on the prospects of what we do, and I think it would be a good time for people to double down, average it out, and possibly top up in this strategy, and continue to remain positive about the market.
Right. Uh, Thank you for that session, Sonam, and thank you to all the investors who took our time on a Sunday morning to join and listen to us. And in case we've missed out any of your questions or you have further queries, feel free to reach out to us by email, and we are always happy to help. Thank you.
Thank you. Thanks a lot.